Welcome back, you legends. I'm Dr. Cal. Let's get right into this weekly update video. The stock market saw a massive short squeeze Friday with the S&P up 2.5%, the Nasdaq nearly 3%, and the Dow 2.5%. Let's take a look at the different sectors. Leading was tech, thanks to a massive rally from Apple despite reporting mixed results and weak iPhone sales. Communication services are staging a comeback after Meta and Google reported disappointing results and saw their stocks collapsing. In fact, Meta just year to date has wiped out 6 years of gains. Look at that. This is just looking exceptionally ugly. Google also reported disappointing results and had a massive gap to the downside, but it's now recovering. We saw the same thing with Microsoft as well and Amazon. So all big cap tech companies reported disappointing results, including Apple, but the street does not seem to care. They just continue to buy it. Microsoft, Google, Meta, Amazon, all in the red. Tesla reported very good numbers. Semiconductors reported mixed numbers. You have to be very careful when investing in semiconductors right now because some are doing well and some are not. This is the weekly performance of the S&P 500 components, and you can see bright green all over the place except for big cap tech, with an exception of Apple. Let's take a look at the weekly performance of the different sectors. Leading were real estate, utilities, and consumer defensive. Now, this is very atypical of a risk-on move, right? We don't usually see defensive sectors like real estate, like utilities, like consumer defensives, like industrials leading, with communication services, cyclicals, and basic materials lagging. So this week's powerful rally in the S&P 500, let's take a look. Up about 4% on the week. This entire move to the upside was a risk-off rally, a defensive rally. And so the market is now sitting at a very weird place where defensive sectors are leading and risk-on growth sectors are significantly lagging and even crashing. And no better chart highlights it than this. This is the Nasdaq divided by the S&P 500 up above, and down below is the S&P 500. Now, I want to highlight something very obvious, but it's also very important. Look at this, everybody. When the S&P 500 sees a rally, it's usually led with the Nasdaq outperforming the S&P 500. The same thing happened after that June bottom that we had. We saw the same thing. In fact, the ratio continued to move up as the market made a new low. And this positive divergence indicated a risk-on move and a continuation to the upside. That's exactly what happened. Now we're not seeing that at all. Now what we're seeing is defensive posturing. The market is bidding up defensive sectors, energy, consumer defensive, utilities, real estate, while the growth sector, while the risk-on sector, big tech, is considerably lagging the market. This is very unusual. This has not happened in any of the bear markets year to date. It hasn't happened once. This is the first time that we're seeing this behavior, and it's very unusual behavior, and it's a big red flag that something is cooking underneath the market. The market internals are collapsing, while from the outside you would think that the market is actually healthy and moving to the upside. Now, it's very important to point out that this could change if the ratio begins to bottom and move to the upside. That would be a positive sign for the stock market. But if we continue to see this breakdown continue as the S&P 500 pushes to the upside, that is going to build a much stronger case for this October bottom not to be the bottom at all, and for more weakness to come in the stock market. In fact, if you've been following this channel for long enough, I did call the bottom on October 13th. In fact, I called it just a day before it happened. I said the market would bottom the next day, and it did. But I also said that this will be the bottom for 2022, not the end of the bear market. I still expect the market to continue to make lower lows and lower highs into next year. In fact, I expect next year to be significantly worse than this year as the recession rolls in and as earnings collapse. Even worse than what we have seen this week. If the market wants to rally, even if it's a rally based on false hopes, lies, hopium, and fear of missing out, it doesn't matter. If the market wants to rally, let it rally. Now, the S&P 500 has reached a very critical resistance level as of Friday. We're now sitting at $390. This is a critical resistance level where we saw significant rejections in the past, and once we broke through it, it acted as support, back tested, and then moved to the upside. So for this rally to continue, we need to see the market break through this resistance level, back test, and then move to the upside, continue to move to the upside. Next week, we're going to have the FOMC meeting on November 2nd. And if the Wall Street Journal article turns out to be true and the Fed begins introducing not necessarily pivot language, but pause language, if they start talking about a pause in interest rate hikes, the market will read that as a pivot. Right now, the market expects the Fed to raise rates by 75 basis points in November and anywhere between 75 and 50 basis points in December, and then pause. If that's confirmed on November 2nd, next week, this will allow the market to continue to rally. If for whatever reason the Fed does not deliver on that promise, this rally will crash and burn. Now let's take a look at the 2-hour chart for the S&P 500, and we do still have potential for a pullback. We do have two support lines that I'm watching. This first support line could act as an important support line going into next week. This blue support line is much steeper than what I like to see in rallies, so this support line will likely fail, and once it fails, the market will want to go all the way back down to this black support line and this 50 period moving average on the 2-hour chart, where it will likely continue to move up and match up with this support line sometime next week. Now, this is a pretty sizable green candle, and big green candle, usually, not always, but usually they retrace back somewhere in the middle. Now, last week, we also had a massive green candle on Friday after the Wall Street Journal article. We had the same thing happen today after the PC inflation report came out. It came in as expected. It is still super hot. Inflation is super high still, but the market is disregarding that as long as the Fed delivers on that pivot. Terrible earnings, the market doesn't care. High inflation, the market doesn't care. Exploding yields, the market does not care. The market is addicted to easy money, and even a hint of easy money, not even printing, just pausing on interest rate hikes is enough to drive the market up. And remember the saying, the market can remain irrational longer than you can remain solvent. So we have to pick our spots here, and all medium-term signals continue to be bullish. So pullbacks should be bought until indicators turn bearish for the medium term, which they have not just yet. And as the market continues to rally, significant disruptions and breakdowns in the internals of the market, like the Nasdaq to S&P 500 ratio, could continue even as the market rallies. So the internals could continue to weaken as the market rallies and pushes to the upside, right up until we reach the cliff's edge, and then we could just fall straight down again. So in terms of medium-term targets, we do have this upside resistance level at $410. If we continue to rally into November, this will hold as a very significant resistance level. Into December, that resistance falls back down to around $400. And into January, 400 will be very strong resistance, and we will likely turn around sometime in January, even if not earlier than that. We will see. With big earnings out of the way, volatility has now crashed. This is to be expected. A lot of volatility was priced into the market. As big company earnings came out, volatility just crashed to the downside. Next week, we'll likely see volatility push up and then crash again after the FOMC meeting is conducted and done with, because a lot of that volatility will be priced out of the market. Now, if the VIX continues to move down below 25 and into these levels, watch out. We could see a rebound and a resurgence of volatility between November and December, especially around the election. Now, let's take a look at the weekly chart for the S&P 500 index, the SPX. And if you remember, guys, a couple of weeks ago when we called the bottom on October 13th, we said, watch out, we're now tagging the 200 weekly moving average and the 50% retracement level. These will act as magnets for bulls to re-enter the market. That's exactly what happened. Even though a lot of people were calling for liquidation breaks and crashes and all of that, We were not in that camp for so many reasons, including the fact that in every single leg down in the market retraces down one retracement level and then moves back up, right? So this was not going to be an exception. We expected a retracement back to 50 and a move above 38%. We will likely continue to push deeper and deeper into this territory where 400 will be significant resistance, and then again up ahead we'll have 410 as even stronger resistance. The 200 daily moving average will continue to act as strong resistance, but please keep in mind that even if the stock market takes out the 200 daily moving average and we close above it, that still does not mean that the stock market has found the bottom and that the bear market has ended. In prior bear markets, including the 2000 bear market, we saw the stock market take out the 200-day moving average, close above it, and still continue to move to the downside. In fact, let me show you. Look at this, everyone. In 2002, the market had already put in a significant bottom in late 2001. Then it rallied. It continued to make higher lows and higher highs. It took out the 200 daily moving average in March of 2002, and then it continued to sell off, making an even lower low. So be very careful. Don't listen to anybody saying that if we take out the 200 daily that the bear market is over. The bear market does not end until the 50-day moving average, this green line, crosses above the 200-day moving average, with the price action trading above both. We need to see the market trading above the 200 and the 50, and we need to see the 50 cross above the 200. If that happens, that will signal the end of the bear market, and that happened right over here, boom, in May of 2003, after a very prolonged period of sideways movement, allowing all of these moving averages to move closer together, tighten up, making that cross up possible and easy. And look at this. Even if you missed this bottom, and you only got into the market after this crossover right here at $90, you would have still caught the market pretty much near the bottom, and you would have had massive gains, significantly better than entering back here in May after the market took out the 200-day moving average. I expect something similar to this, not exactly. No bear market is like the other. It's going to be different every single time. Just something that I wanted to point out. Now, momentum continues to be bullish. We do have this bullish divergence with the PPO making a higher low. We talked about that. It signaled the bottom. That's why we were confident in calling the October 13th bottom and riding this wave to the upside. I am still personally running a long and short book. We have to be careful even as the market rallies. Pullbacks are still possible, but keep in mind that the last two bear market rallies were very violent. We did not see a touch of the 20-day moving average, not even once, right up until the top was in, and we had already reversed to the downside. Is it possible? Could we see a deeper pullback? It is possible. We saw that earlier on after that June bottom. We had a couple of deep retracements. This was one. This was another one. However, after the uptrend was established, the deepest pullback was only 9 days shallow. So pullbacks to the 9-day moving average will be money in the bank as long as this uptrend continues to the upside. That likely means the market will not revisit this $380 level unless we get something crazy next week. Otherwise, the market will continue to ride this 9-day moving average. It's a completely different story for the Nasdaq though. The Nasdaq is significantly weaker with the S&P making a higher high while the Nasdaq making a lower high. Again, all comes back to this ratio chart, which is looking horrendous. We definitely need to see this ratio chart putting in a bottom. It is possible that this is the bottom in this ratio chart. We need to see it now recover, move to the upside. We need to see the triple Qs outperforming the S&P 500 for this rally to continue. Otherwise, if we take a look at the Dow Jones, which has been leading the stock market up throughout this rally, the Dow Jones is pretty much at its resistance level, a very key resistance level where we saw significant sell-offs in the past. We could overtake it. We will likely overtake it slightly, trade around the $330 level for the Dow Jones. then money may perhaps start flowing out of the Dow and the industrials into big cap tech companies, allowing the Nasdaq to recover and allowing this ratio chart to recover. Keep in mind that if we don't see that, this rally will be very short-lived. Now let's take a look at the smart and dumb money indicator. Up top is the smart money, the high yield bonds, the HYG. Down below is the S&P 500. A bullish divergence between the two continues to develop, and the reason behind that is that we're seeing a disconnect between low yields, declining yields, and the Nasdaq. Usually when yields decline, the Nasdaq moves to the upside. In fact, let me illustrate that. This is the 10-year yield, and up above is the Nasdaq. When the 10-year yield moves up, usually the Nasdaq moves down. However, when the yield moves down, it usually allows the Nasdaq to rally. We're not seeing that now. Unfortunately, the yields have been moving down for 3 straight days, and the Nasdaq has been weakening regardless. My interpretation of this is that this is likely the result of a distortion due to earnings from big cap tech companies. Now, earnings out of the way, this distortion should end. A continuation of the decline in yields should allow the Nasdaq now to catch up. If that doesn't happen, again, be warned, this rally will be short-lived. Now let's take a look at the dollar. The dollar again made a significantly lower high on the daily chart with a significantly lower high on the PPO. This is a very typical topping formation that I talked about in prior videos. It's called a spike and a cup. At least that's what I like to call it. The psychology behind it is that we get a melt up, the market tops, then bulls try to recover. They try and try and try. They get a lot of resistance from bears at the top. Then it fails again. We had the exact same topping formation in oil. Right here, oil topped. We had this cupping formation. It failed. We had another cup. It also failed. I also talked about this formation working as a bottoming formation, a spike and a cup. The exact same thing happened in the March bottom in the S&P 500. Now, very important to mention that if the dollar continues to move down, ending this incredibly powerful run since early 2022, if this comes to an end, and if the dollar fails to regain its momentum back in this ascending channel, we will very likely see the most powerful rally in the S&P 500 for the year. Because one of the principal reasons the market kept on declining was the spike in yields and the continuation of the upside in yields, as well as the dollar. Now, if yields and the dollar continue to move down, and they will likely do that because this is a significant topping formation with a negative divergence on the 10-year yield, a slightly higher high on the price action, significantly lower high on the PPO. This is a classical topping formation. We've now closed below the 20-day moving average. We're trying to recover. This recovery will likely fail again. If the Fed delivers on that pause language next week, yields will continue to move down, and hopefully this will allow big cap tech to regain leadership, helping the S&P along, fueling the second run up in the S&P 500. Now let's take a look at some individual stock charts. This is Microsoft. Microsoft has now successfully retested this prior low. I was hoping for a slightly deeper correction so I could buy some Microsoft for cheap. That did not happen in the real market. It happened in the pre-market. Microsoft did sell off into these levels in the pre-market and the post-market, and it just ripped to the upside on Friday. Now we do have this significant gap and significant resistance level. I expect Microsoft to continue to rally right up until we hit this resistance level again, and Microsoft will likely now chop in this range throughout the year, and then selling will likely continue in January, as I have outlined earlier in the video. Let's take a look at Apple. This is an insane looking candle, right? It's up 7.5% in a single day. This move is insane for a company as big as Apple. Not only did we gap up, we ran after the earnings. We took out that resistance level at $152. We blew past it. And this insane market movement was made possible by the fact that Apple was the most shorted stock for months now. It was Tesla for a while, then it became Apple. And they shorted and shorted and shorted this company all the way down. and all of those shorts got squeezed hard on Friday. Again, this is a pretty insane looking candle, and massive candles to the upside like this usually retrace somewhere down the middle. Here's another example right over here. The market rallied, retested, rallied again with a massive candle, retraced down the middle, and then continued to move to the upside. Then rallied, retested, we had this massive candle, and we'll likely see some retracement before moving to the upside. Let's take a look at another chart. This is XLY, consumer discretionary, divided by XLP, consumer staples. I did not edit anything in this chart since October 19th. In fact, if you go to my video on October 19th, you will see me draw out this chart. And so what is happening is that we have now completed this full measured move to the downside in this risk on, risk off chart. In a rally, we would like to see consumer discretionaries outperform consumer staples. That would indicate risk taking in the market and a nice rally in the stock market. We have now completed this full measured move to the downside, and we are now beginning to recover. Hopefully we'll see this continue to move to the upside. If we see that, this will lend a lot of credence to the bull thesis that the market will continue to rally right up until we hit that $410 resistance level. Now, the two biggest consumer discretionary companies are Tesla and Amazon, and I do love me some Tesla at these levels. This now looks like the bottom for Tesla, right? We had a low and a lower low with positive divergence on the PPO. We're now sitting at the neckline of this W double bottom formation. Usually this formation moves to the upside by the same height from the bottom to the top. That will take us up to, let's see, $260, perfectly in line with this gap right over here. So I do expect Tesla to continue to move up in the next couple of months to hit $260. Let's take a look at Amazon. Amazon looked incredibly ugly pre-market. It was trading at $90, taking out all of these lows. It looked incredibly ugly, but Amazon bulls should now feel some reprieve after putting in this low with a significantly higher low on the PPO. This is a bullish divergence, and as long as Amazon continues to recover, we will likely see it continue to rally right up until at least $120. Let's take a look at another chart. This is the CPC put to call ratio buy and sell signal. This is my own variation of the signal, which so far year to date has been 100% accurate in marking stock market reversals. Now, the traditional CPC signal was all over the place, so I had to refine it, work on it for weeks until I came up with this variation, which for this year has been 100% accurate, marking major reversals to the downside and upside perfectly. This signal was triggered after putting in the low on September 30th. We then had that successful retest on a closing basis. The S&P 500 actually never violated the September low. On an intraday basis it did, but on a closing basis it did not and made a higher low, and then we continued to rally. And we will likely continue to see this rally to the upside right up until we fill this gap at $410. And the CPC put to call ratio buy and sell signal still has an active buy signal. And the correct way to trade this signal is to go long when the buy signal is active and stay long until it switches to a sell signal, at which point you should exit. I made a member exclusive video for our trading community on Discord on how to set this signal up on TradingView. You can set it up on a free TradingView account. You don't need a premium account, but it's a little bit tricky to get it right. So I did make a video guide on how to set it up. By the way, guys, this is what the trading community looks like. I will leave a link in the description below to join if you want to do that. This is where I post every single trade and investment that I make, my daily intra-market, pre-market, and post-market analysis, as well as my investment ideas, my weekly watch list, and weekly expected moves for major indices, as well as many individual stocks. I also publish member exclusive videos on specific strategies, trades, and on indicators, specific indicators. I've also launched a new feature called My Charts, where I will be posting a live link to every single chart and every single indicator that I follow, including individual stock charts, index charts, S&P, Dow, NASDAQ, all of my ratio charts, and a live link for that CPC buy and sell signal. I also share trading resources, including market research, guides, and learning resources for new traders. There's also a members section where members can discuss the market, news, investment ideas, trade ideas, their own charts, as well as our legendary trading room where only our best traders are allowed to post their trades live every single day. There's also a Q&A section where every single living legend member can ask me anything they want, and I'll do my best to answer as quickly and as best I can. We do have 2 membership tiers, everybody. We have the Living Legend membership. This membership is capped at 1,000 active members. Living Legends get access to all of the members areas and all of the Money Time Machine channels, including my trades and live alerts and my analysis. They also have 24/7 access to me. This membership is capped at 1,000 members simply because I want to maintain a specific standard of quality where I am able to interact and serve all of the Living Legend members as best as I can without any compromise. I will be slowly expanding the cap over the next few weeks. As soon as new membership slots are available, you will be able to sign up using this link. If you click on this link and you're able to sign up, congratulations. It means you actually were able to secure one of the rare spots that I'm opening. Now, there's also a second membership tier called Ghost Legend. Ghost Legends get access to all of the Money Time Machine channels as well as most of the members area channels, but they are not able to interact or post anywhere except in one single channel called the Graveyard. Both Living Legends and Ghost Legends are able to interact with each other in the Graveyard. However, access to the members area sections is only observational. You will be able to see everything that's posted here, but you will not be able to post or interact with me or other members in these sections. Again, simply because I don't have the personal bandwidth to be able to directly interact and serve more than 1,000 members at once. If you sign up for the Ghost Legend membership, you will be able to upgrade to the Living Legend membership once more slots are available. This membership tier is available at a 40% discount as of right now. I just launched this membership tier, so this special discount launch will only be available for a limited time, and it's 40% off, comes out to about $30 per month if you go for the annual membership. So if you like my work, if you want to support me and support my work, this is the best way to do it. You don't need to sign up for anything, everybody. All of the YouTube videos are going to be free and continue to be free forever. But if you want to get access to more cool stuff and more timely data, more timely analysis, real-time stuff, as well as exclusive access to my own portfolio and my own trades, this is the way to go. Check out the link in the description if you're interested, and thank you so much for your support. Now let's take a look at the fear and greed index, everybody. We're now at 61. We went from extreme fear to greed in 2 weeks. We'll likely see even extreme greed over the next few weeks as the market continues to rally. We're now seeing market momentum approaching the 125-day moving average. This is the medium blue line right here. We took it out in the August rally. We failed to take it out for more than a few days in the April rally. We will likely take it out again, and we will see if we will fail at $400 or if we're going to be able to close this gap at $410. Stock price strength has now bottomed and is now moving up. Stock price breadth continues to move up. In fact, I talked about this monstrous divergence between stock market breadth and stock market price action as early as early October. This monstrous divergence always leads to a massive rally in the stock market. The last time this happened was in 2016, and the market rallied by 15% in 45 days. Breadth has now taken out these prior highs, and it will likely mean that the S&P 500 will continue to push up past these highs and into this new resistance level. In fact, back on October 13th, I did say that this indicator will continue to move up and that the fear and greed index stock price breadth indicator will eventually turn back up. And look at that, it did turn back up about a few days later on October 20th. But this signal is significantly faster and more reactive, and so it is more accurate, and that's why I prefer this signal. Again, if you're interested in analysis like this and charts like this, you will find all this stuff in the trading community. Put to call ratio, again, we called out this head and shoulders top. We will likely continue to move down as the stock market rallies. Market volatility has now crossed below the 50-day moving average. That's a positive sign, but we could still see spikes to the upside at this level. It is common. We commonly see spikes at these levels. Look at this. A tag and a spike, a tag and a spike, tag and a spike, tag and a spike. Boom. We tagged it. We went below it. We spiked. We retested it and failed. We'll likely see something like that. So there will be more buying opportunities in the next week or so. Safe haven demand, we're now in extreme greed. Stocks are significantly outperforming bonds. Junk bond demand is now improving with the yield spread collapsing. Next week's earnings, we will have NXP after the market closed on Monday. This is a big chips company that supplies the auto industry, and so it will likely do well. And it is going to be very important to watch for guidance on NXP for Q4 because that will help us assess the health of the economy, because as we all know, auto companies, industrials, when they're doing well, the economy is doing well. Tuesday, we'll have some more companies, including Uber, Pfizer, BP, Petroleum. We will also have Devon Energy after the market close, and we'll have AMD. Again, watch for AMD's guidance for Q4. We saw horrendous guidance from Intel, and Intel still rallied. That's because semiconductors have been significantly underperforming the Nasdaq, and they've now begun a new uptrend, a new period of outperformance of the Nasdaq, which is why I really like semiconductors at these levels for a long side play. Wednesday, we'll have Roku as well as Qualcomm, Marathon Oil, Robinhood. Poor Robinhood just completely crashed here today. One of the worst performing stocks in the entire stock market. Etsy is a consumer cyclical, consumer discretionary stock. And again, as we've seen XLY beginning to bottom and potentially move to the upside, this could help companies like Etsy move to the upside. But be very careful with these companies because they usually report horrendous earnings and then begin to recover. So Etsy can still report terrible earnings and crash and then begin to recover just like Amazon. Thursday, we'll have PayPal and Coinbase as well as Starbucks. Before the market open, we'll have Moderna, ConocoPhillips in the energy, and Cheniere Energy as well. Two of the most hated stocks this year, Peloton and Nikola. And Friday, we'll have some more of those Cathy Wood sort of stocks like Fubu and DraftKings. What's important is that big company earnings are now out of the way. They have been priced in. We need the FOMC meeting next week to also be priced in. That will allow, hopefully, the market to continue to rally into November. Now, in terms of stock market valuations, the stock market continues to be extremely overvalued compared to the historical average. We did retrace down significantly since that August rally, and so we will likely see some nice push to the upside, especially as yields calm down. That allows earnings multiples to expand and valuations to expand, so we could see a nice rally as long as yields calm down, and they will likely calm down if the Fed signals that pause next year in rate hikes. Let's take a look at the economic calendar. Monday, we'll have the Chicago PMI. Tuesday, we'll have the ISM manufacturing PMI as well as the jobs openings figure. On Wednesday, we'll have the employment change as well as the Fed meeting. 75 basis points is expected for that Fed meeting. It is now going to be very important to watch for the dot plots for December as well as next year. We will likely see 50 basis points in December and then 25 next year, and that will take us up to 5%, where the Fed will likely want to pause as long as inflation begins to cool down. If we get another hot inflation report where we make a new high on inflation, the Fed will need to hike rates even more. The Fed's terminal rate at that point will have to go up over 5%, which is not priced into the market at this point. Thursday, we'll have the labor costs as well as balance of trade and the services PMI. Friday, non-farm payrolls and the unemployment rate. If this figure ticks up over 3.5%, that'll be very bullish for the market because the Fed wants to see unemployment go up to at least 5%, maybe 5.5%. And if it begins to tick up this month, that will give the Fed the confidence it needs to perhaps talk about a pause. That's all I have for you today, guys. Thank you so much for watching, and we'll catch you in the next one. Bye-bye.
Oh, wow.